Well, banks, miners, healthcare, tech. Investors often talk about sectors, but should they? This week on Wealthy and Wise, we're asking whether great returns come from picking the right part of the market or simply finding outstanding businesses, regardless of what sector they're in. So we'll add some value, go head to head, talk some specific stocks, and we will answer a viewer question at the end. Well, some investors build portfolios around sectors and themes, while others ignore the labels and focus solely on the quality of the business. In this segment, we'll explore whether sectors really matter, whether the long-term returns are driven by finding great companies with strong fundamentals, and that's it. Welcome to the program, Sanjee Narendran from Teaminvest, and also Andrew Whiteland, who's joining us today from DP Wealth Advisory. Lovely to have you both here. So look, Andrew, just to start, as an investor, should you be thinking about sectors first, themes first, or how do you do it?
It's a really interesting question, Nadine. It's almost like to me, it's almost like an inverse pyramid. So you start with the broader economy. Do I want to invest in Australia? And as an example, and we'll talk about tech in a minute in Australia, but Australia's not really known for tech. It's known for banks and it's known for materials and resources. So you start with the country, and then you drop down to the sector, and there may be standout companies within that sector that you really want to target. Or because the sector itself is so compelling, so take the banks. The banks make $30 billion after-tax profit every year. Trying to pick which is the best bank is a bit of a nonsense. Whereas there might be a particular resource company, you may prefer BHP because of its copper exposure, or you may prefer Rio for its aluminium exposure. So to me, it's a difficult one to answer, but I keep coming back to, given the ETF bias that I bring to this chat, SPIVA, the report from Standard & Poor's, tells us that 85% of people who try and beat the market by picking individual companies will fail over 15 years. Doesn't mean that you can't do it, and there are some very skilled investors out there that can do that. But, if I was crossing the road and there's an 85% chance I'm going to get cleaned up every time, not exactly compelling odds. So to me, that's why I use a basket, unless there's a healthcare company that's trading at a 20-year low, as an example.
Yeah. Okay. Well, we might get there in the end. Sanjee, do value investors ever think about sectors? I think you guys might have covered this a little bit last week. Or do you ignore them completely?
I'm closer to the spectrum of ignoring them completely. I mean, you don't want to be all invested in one industry, one sector, but at the same time, if you can find individual businesses to invest in, you're able to then construct a better portfolio for yourself. If you think about people that have built material wealth in their lifetimes, most people have done it off the back of one or two companies. They've built their business or built that business that they were heavily invested in, and that's how they've got there. So trying to diversify and getting exposure to everything can really lower your returns. But I think if you're going to start investing, one of the first things you need to ask yourself as an investor is, how active do I want to be? And if you're willing to put in some work, understand the businesses that you want to invest in, and have a deep knowledge around that business, picking out individual businesses can be a really great avenue for you to get those really high returns. But if you don't want to be so active, then you've got the options of going to an expert that does do the work and does have the understanding of it, or alternatively go in and find some index or ETFs or things like that you can put the money in, and it will do a nice average.
But what you're saying is, if you have the mindset that you need to own every sector, you will be in your disservice if it forces you to own businesses that you don't really like.
Yeah, absolutely. I mean, there's a lot of talk in the industry about, you've got to have exposure to mining and have exposure to healthcare and exposure to banks and things like that. It's not necessary if you're trying to build wealth over the long term and material wealth. If you want to outperform an average, you take an index, any index, whether it's sector specific or not, if you want to outperform that index, what if you held the companies in that index without the bottom 20% of losers, right? It's so much easier to spot a dog or spot a business. If you look at any portfolio or index portfolio, whatever it is, there's automatically some in there you say, they are dogs, I don't want to own them. And you get that discretion as an investor picking out individual companies to avoid all of those dogs. And just by avoiding the dogs, you can outperform that index.
Well, you can write a reply to that. No doubt you will.
How much time have we got?
But I mean, sector ETFs, if we just break it down, sector ETFs have become very popular. What problem do you see them solving for investors?
So again, I'll use the banking example, and we look at, say, CBA. And a CBA is a magic business. It's a really, really, really good business. But is it worth, on a valuation basis, double that of JP Morgan? I don't think so. So to me, and I think one of the issues, if we pick on CBA specifically, is capital gains tax. The people who paid $5.40 back in 1991, similar to CSL, where CSL, they paid $2.10 from memory, and the 1990s went all the way to $300 more, $320, were concerned about capital gains tax, chose not to sell, and here we are at $120. So to your point around sector specific, it's basically it helps you identify, I want exposure to a particular theme, but without actually trying to pick the winner, because if you can pick the winner, all power to you. I'm certainly not suggesting that if you have the skill set and the time and the capability, you should try and pick that winner. I'm suggesting, though, that, and that 85% number I gave you, that's for Australia. If we zoom out and look at the US, which is a much deeper market, and there's 90 years worth of history, we've only got 20 years worth of history. In the US, that number is 95%. So I spent some time with Standard & Poor's in New York in 2018, and I'm a reformed used share salesman for those playing at home. And they basically broke me at Standard & Poor's. And what they showed me was that 95% of active managers fail over 5 years or more. So we then looked at the 5% that actually outperformed and looked at their performance for the next 5 years. So unsurprisingly, 95% of those active managers failed to perform over the next 5 years. So there's always a Warren Buffett or a Teaminvest. I'm not suggesting for a moment that there aren't capable, skilled people out there, but they are very rare. And so, to your point, if we're sort of basically going, I don't have the time or I don't have the inclination, either pay somebody, and that's certainly a very sensible solution, or the other sensible solution, given what's going on with the ETF market at the moment, is we've now have 458 ETFs with close to $450 billion worth of funds under management. And a lot of them are passive, low-cost track and index ETFs. So we're picking on Australia. They range in anywhere between 3 and 8 basis points, 30 and 80 cents for every $1,000 that's being managed. Incredibly cheap. Save you having to pick a winner. But to your point around sector specific, if I like healthcare or I like banks or I like materials, rather than try and pick an individual one, buy that sub-indice. Because in Australia, you've got those GIC sectors. I think there's 13 from memory. Just do an ETF that chooses those.
So we hear a lot about sector rotation. Is trying to predict the next sector winner worthwhile in your view?
I think there are some obvious times where it's yes. So at the moment, resources, as an example, given the inflationary outlook, and so trying to buy a sector-specific ETF makes sense. But then, and I'm mindful of time that I've been talking too much, but, which one do you follow? Do you one that just follows an index? Do you follow an equal-weighted one? There are particular ones to do. But there are periods of time, like say technology as an example, where just because tech is cheap doesn't necessarily mean you need to be buying it. It's cheap for a reason. It's under pressure for SaaS apocalypse or whatever. So, Nadine, it depends.
Yeah, right. So, Sanjee, can a great business overcome being in a very sort of out of fashion, out of favor sector?
Absolutely. I mean, a great business, when you identify and find those great businesses, what we would look at Teaminvest is a business that can withstand, market fluctuations. I mean, take price out of the equation. If the business is going to be materially larger 5, 10, 20 years in the future, that's a business you would want to be invested in. if the earnings keep growing in that business over those 20 years, it's going to be materially larger, and the share price will keep up with that. In the short terms, the share price will fluctuate. You're going to get times of overvaluation and you're going to get times of undervaluation, but materially it will track with the earnings of the business over a long enough period of time. So one thing that investors have got to do is give themselves time and allow that compounding effect. And as Andrew was talking about with CBA and CSL back in those early days, being able to buy them at under $5, under $3, right? And allowing that to materially grow, because those businesses are now materially larger than they were. That's the type of businesses you'd want to find. And trying to pick these winners, and I think Andrew would agree with me, it's an impossible task. It's very, very hard to try and just start picking winners. But there's a lot more information, there's a lot more data on losers. And you can do really well just avoiding losers. So the more what we refer to as dogs, the more dogs you can identify and kick out of your portfolio and not waste time on them, it gives more room for those other stable, sustainable companies. And be as selective as you like in identifying those dogs. Be as tight as you can and find any reason to kick them out of the portfolio until you have no reasons left, and look at that business in more details and say, is this a business that can continue going like this over the next, or over my lifetime, hopefully?
Sanjee, if all of your best ideas ended up in one sector, would you be comfortable with that?
I would be comfortable having 2 or maybe 3 sectors. I mean, I'm not as, in owning the business, I don't have enough capital to buy it outright and be hands-on and make decisions. Whereas if you can do that, you alleviate some of those risks by spreading it off over a few different sectors. Sectors will go through hard times and good times. So when it's going through a hard time, I mean, right now we're talking about healthcare has taken a whack. We're looking at AI that had a huge run up, and tech had a huge run up. Now people are on the fringe about it, and isn't it going to hold up there? It's already, being impacted. Those things can happen, but if you can look past that, over 5 years, over 10 years, is it really going to be a thought? Think about 5 years ago or 10 years ago, all those worries that we had with companies back then, are they still the same problems now? If you found the good business at that time and stayed invested in it, it would have done the catching up.
I don't think you're saying in any way that you don't like quality companies and, companies with strong earnings. So in your opinion, 2 things. How important is sector diversification? Should investors diversify, by individual business in your view, or do it a different way?
It's a really tough question, because if I'm true to my passive self, and as you know, I'm just a teddy bear, Nadine, just a lamb. If you're true to your passive self and look at the S&P 500, the top 500 companies in the US, it's around, for the sake of a round number, it's about 40% tech. That is troubling. Here in Australia, again, I'm just using round numbers, materials are around 35% of the index, banks are around 28, 29% of the index. That is troubling. So if you're just taking a purely, I'm just going to be passive, then you would just roll with it. But I'd also argue just by making a decision to invest, you're actually being active. Because otherwise you just leave the money in the bank, and with interest rates at a decade high, you can get, 4.5%, 5%, take no risk. So the way that we construct our portfolios, Nadine, is we operate under a core and satellite approach. So we basically have a core, passive, low-cost portfolio, albeit we have tilts. So as an example, our portfolios are underweight US and they're underweight tech. So we've been achieving market-like returns, but taking 20% less risk in doing so. And we've been doing that. So as an example, there is a broad-based ETF that follows the MSCI, the Morgan Stanley Capital Index. We don't use that. We follow an index that follows the rest of the world, ex-US. So That's what the core does. And then to your point around satellites and quality, as you know, I do like that quality factor. Factors are a determinant of share price. So interestingly, though, quality has underperformed over the last 12 months until you realise what's one of the main drivers of quality, and that's tech. Because tech has got strong earnings, low levels of debt, and so it has been dominating that quality factor in those ETFs. So I'm not trying to hedge my answer here, but it's high level. It's a core portfolio, passive, have some tilts as to which way you want to go, but don't go too far because, as we've said right from the outset, try to pick winners. It's a folly.
So if you had to choose, Sanjee, just before we go head to head, would you rather own the best business in an average sector or an average business in the best performing sector?
Obviously, the best business in an average sector. I mean, the sectors will go up and down. I'm not fussed about the sectors. I'm not worried about short-term prices and so on. I would rather
look through the cycle.
Look through all of that, find the best businesses. But I think to identify that and to know that this is the best business, you've got to put in some work. And the same thing applies to index funds and ETFs as well. You need to put in the work because not all funds are the same. Someone like Andrew, I know, would go and do a lot of research into the way these funds operate. What are they benchmarked against? What do their fee structures look like? There's a lot of work. And even though they may present the same, they can be very, very different. So you do need to go and put in that work regardless, but identify where do you want your portfolio to be? What am I okay with? And go there. But I'd rather put it into the actual business, underlying business.
Okay, we've got a man for the business and a man, let's say, for just approaching it a bit differently. All right, let's go head to head. We'll go into a few companies and also find out if there was another way we can play it as investors. Okay, in this segment, we'll compare 4 businesses from 4 very different sectors. We'll ask whether the sector should influence the investment decision, whether the quality of the business is all that really matters, or if an ETF would be a better way to gain exposure to both. Same guests, Sanjee and Andrew. Thank you for sticking around. All right, I will just be clear with the audience that these were Sanjee's picks for companies for us to discuss. And I like it, though, because if you've been watching these episodes, you would know that we spoke about XRF a couple of episodes ago. One of our guests called it perhaps the best managed company in the smaller end of the market. You guys at Teaminvest love it, I know. But what attracted you to it beyond the fact? Because it is in an attractive sector.
It is. It's somewhat, people can say it's exposure to the mining sector because they do the sampling and things around the mines. They've got a broad range of different commodities that they test and sample. I look at it more of an engineering company, an engineering business that services the mining sector. And it is a business that will continue growing, whether the mining sector is going through upturns and downturns. It is a business that they can keep. They're still going to be testing samples. They're still going to be checking the quality of items. They're still going to be producing the machinery required to do that. And there's a lot of consumables that go with that. So it's a business that I see that can continue to make money. And if you look at what it's done over the last 10 years, it has continued to do that. And I expect that it should continue over the long term as well.
So, Andrew, would a company like XRF, which I know you're familiar with, typically make its way into an ETF portfolio, or is it just simply too small?
It's about 250 million round numbers, something like that. So in a ASX 300 portfolio, wouldn't make it. So like a VAS as an example. But it may make it into a smaller cap ETF. So there are a number. So we've been talking about passive ETFs. There are also what we call active ETFs. So again, these are the guys and girls that are taking tilts. So it's highly likely that a quality company like XRF may in fact find itself into a small companies fund. I guess though, and I'm all for the picks and shovels, no pun intended. I'm all for the picks and the shovels. You could laugh at least. I'm all for the picks and the shovels relating to sort of rather than playing the thematic play, the service providers that do that. And we've been doing that with AI around electrical supplies for data centers, as an example. Same sort of mindset. But I guess in my particular case, I'd be more inclined to look at a QRE, which is just that broad-based ETF, but it tracks the material sector. So it's 41% BHP. So there could be an equally compelling argument. Why wouldn't you just buy BHP? Or something like MBR from Van Eck, and it just literally has like an equal weighted approach to different resources, or even Tribeca, TGF, which has a global resource fund.
I should have asked, I know that you like ETFs. I know that you're a big tool for you, but do individual companies still matter to you?
Yeah, 100%. And I would love to find the unicorn. Just to be super clear, if I could find the unicorn, I'd be on an island somewhere, pina colada.
Wouldn't we all?
Yeah.
But that's my point.
Yeah.
It is super, 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 super difficult to do. And 90 years worth of data in the US or 25 years worth of data here in Australia says that it is super difficult to do and or expensive from a time and a cost point of view.
Yeah. And that's why you guys aren't chasing every unicorn,
No,
right?
no, we don't chase unicorns at all.
Yeah.
Couple of
We're mythicals. They don't exist.
You're getting rid of the dogs, and you're also
Get rid of the
you've
dogs.
got a limit on the amount of companies that you're looking for.
No, exactly. I think what we do is we shorten our field of looking for what I commonly refer to fishing in the small pond with the best fish. So you can do that once you've eliminated a lot of the dogs. And I get this with fund managers that I have lunch with and I have drinks with and so on. We're talking about different companies. And often they'll say to me, oh yeah, I've got that in the fund. I wish I didn't, but I have to hold it because they've got a mandate, or that's what the fund is designed to hold. So it's very restrictive. And the way the industry works, sometimes the more restrictive it is, the better the rating houses and the rating agencies value that, and you get better ratings for being as restrictive as possible. It's done for a purpose. So it absolutely suits the purpose. But what it does is it also caps you towards that average, towards that middle of whatever that industry or sector or fund is going to produce.
It's a really good point, Sanjee, because the other thing we have to think about, without being all political on you, is that the government has a mandate relating to super performance tests.
Yes.
And if I'm an active manager and I stray too far away from a particular benchmark or index and I suddenly have underperformance issues or significant outperformance issues, which is not sustainable, I start getting strikes. And after a certain number of strikes, I've actually closed my fund. So there's actually in my view, there's a structural issue relating to these performance tests, which the federal treasurer is currently reviewing. And hopefully they're addressed. But to your exact point, that's one of the reasons why fund managers, active managers, hold these underperforming positions, because they have to stay true to the index.
Okay, that might be another episode. All right, let's skip to CSL, shall we? So CSL has long been considered one of Australia's highest quality businesses till things changed, as we don't need to go over again. So, the quality still speaks to you as an individual business, even though the sector has a cloud over it?
Absolutely. I think CSL, to me, has a incredible moat in terms of being able to distribute biohazardous products around the globe very easily. They're probably one of the biggest distributors of biohazardous, blood and things like that. Very similar to Coca-Cola, being able to get that around the globe. By CSL, when I don't see it as the demand for, CSL's products, they've got a range of them, but falling off. I think they will continue to grow. It's just been a slower growth than what the market was picturing it as. The market was picturing it maybe 5, 10, 15 years ago as a high growth business, which commanded PEs of 40 to 50 times earnings. It didn't have that growth. So that was an overvaluation by the market. It shouldn't have been at those high levels for so long. But if you look at what it's done as a business in terms of its underlying earnings, it has been growing. It's been steady. This year, it's probably going to be stagnant from last year, but last year was a record year.
So you're not for turning out of CSL to get into other names in the healthcare space. You still stick with that individual business. CSL, so big, such a long history, major index constituent still, even though, it has encountered some problems with its share price. Does its size make it a cornerstone sort of holding for ETF investors, even when sentiment turns against it? Is that what we're saying?
Yeah, so just after COVID or peak COVID, September 2020, sorry, I'm not trying to trigger anybody with that statement, it was the number one company in Australia. Today it's number 11. May have ticked up just a little bit because of that recent rally in the share price. So let's just reflect upon that for a moment. So bigger than CBA, bigger than BHP, the number one company. And today we'll say number 10, I like round numbers, they're the 10th largest company. So certainly part of your passive ASX 200, 300 ETFs, 100%, the weighting may have changed a little bit. But if I can take exception for a moment relating to the proposition that it's a quality company, this is a company that actually doesn't have a full-time CEO at the moment, or a permanent CEO, I should say. Now, it doesn't mean that they won't find said person, but whilst they have the person there who's, with due respect, warming the chair, are they going to be making courageous decisions? No, they're not going to be making courageous decisions. You've got significant geopolitical issues relating to the US and their CSL's ability to source plasma by virtue of people from Mexico coming across the border to provide them with plasma. You've got the fact that they overpaid for Vifor, and you've got a number of the patents that are actually going to be coming off over the next 18, 24 months. This, in my view, was a quality company. It was an incredibly well-managed company that was priced appropriately, if not overpriced. And what tends to happen, Nadine, is that it goes from overhyped to big time underhyped, which is why it went to $90 or wherever it is. And what are we today? About 115, 120, something like that. And it's now probably about right. But we've got profit reporting coming for them on the 18th of August. I would be incredibly careful around stepping into CSL prior to the 18th of August, because it's either going to go really, really, really well, or my view is not so much.
Okay, but you still like it because you're long-term. You'd still have exposure, likely through an ETF.
Through your passive.
Through your passive core ETF.
But to my point, it's no longer the biggest holding.
Yeah.
It's now number 10 because the market is recognising that it wasn't the quality business of September 2020. And I guess, Nadine, that's to me the biggest benefit of an ETF. I don't have to be doing the work of kicking out the dogs, because the index, when it gets reweighted every 3 months or 6 months or annually or whatever index we're talking about, does that for you. You don't have to be doing that. Similarly to, you may recall, I did the call with Henry one day, and I said that Woolies was a buy at $30. The buy of the decade, I think, was the term I used. And I was pilloried accordingly for about 6 months, but here we are, it's about $38. In that same example, I'm not raising that because I said it, I got it wrong because it went to 27, but the index would have been buying it as it was starting to increase it in market valuation. So again, I didn't have to go in there and tactically work out when was the best time to buy. Was it 30? Was it 9? Was it 28? The index would have done the reweighting on the up or the downside.
Look, this is a real head-to-head here. I like it. It makes for some good television. So you guys have really sort of fleshed out your points, and I don't think we need to go into any more stock specifics, but would you also say that a few or a handful of very carefully chosen stocks, individual companies on their merits, could really improve a sort of diversified portfolio approach?
100%, or it can also diminish. So to me, part of it is having that really strong fundamental framework that Teaminvest has, 100%. I would also overlay that though with a strong technical sense as well. And what I mean by that is what's the trend doing, but in particular, what's the flow, so if we're talking ETFs in particular, how much money is going into or out of a particular ETF, and the combination of that strong technical piece, and then having that strong fundamental piece rather, and then having that technical piece and the two together. But there's certainly a place for direct shares if you can find the unicorn and the rainbow.
Yeah, well, interesting, because what I'm taking away from this as well, folks, hate to break it to you, that if you're doing this yourself, it is work, isn't it, Sanjee? You've got to know the individual companies and know them well, and don't get caught up in the sort of hype around specific sectors.
It is absolutely a lot of work. Now, luckily, what we do at Teaminvest allows us to cut through that work, and doing the work as a group, as a team. When we've got 750 members, everybody's pulling in their expertise and being able to understand these businesses a lot better. That is an advantage that we have, that people at home, I understand, may not have that same advantage. But they all do have their own circle of competence. They have their own expertise. It's, can you use that to apply to your investing? Do you understand the business? Are you capable of making those type of investment decisions? If not, then trying to find somebody that can help you is a total valid thing to do. But if you do have experience, if you do like doing the research, do understand the business, and want to have that mindset, then go out, do the research, explore, understand the business.
Well, look, I think it's been a really good discussion. Do it yourself with the backing of your team, or get advice. Get somebody else to do your homework for you. Look, we are agnostic here. We just want to empower you to be great investors. Look, Andrew, thank you for jumping into the conversation. We really appreciate it. Andrew Whiteland from DP Wealth Advisory. Sanjee is sticking around because I've promised we'll get to a viewer question this week, and we will do so because you asked. Well, if you would like the team to answer a question for you, just email wealthy@ausbiz.com.au. So this week for Meg, she asks Teaminvest, what's the company you're most interested in its results this reporting season, and why? Sanjee Narendran from Teaminvest is here to talk us through it as a value investor looking for not the unicorn, but to get rid of the dogs. What company are you hanging out for?
Actually, we were talking about it earlier, CSL. I think CSL has had a lot of noise. There is a lot of noise going on around CSL, and it would be remiss just to ignore it. So we can't ignore what's happening. I think I understand the business well enough, and a lot of our members would too, to understand it to the depth that we can see how a board comes up with the decisions they make. I can see why they may have an interim CEO for a year, because the person that it takes to turn around a business is a very different CEO to the person that it takes to grow a business from here on out. So those type of things, I can understand it from my perspectives. But it's something that does require us to pay attention, with the owners of the business. Now, management are working towards doing something, and they are making some changes towards their strategy and their future. I'd like to see what they are.
Mm-hmm. And so to Andrew's point, though, because I know that you guys have held CSL for a long time, but would you, if you didn't own CSL, would you be, wise to wait for the result to see what actually happens in black and white?
Yeah, we've followed CSL for a long time. Not everybody's held CSL for a long time. So there's some members there that have had it since the IPO. There's members there that have held it for a very long time. There's other members that have got in on the dip, like myself included, as it came off. I didn't have the chance to buy in when it was overvalued, but when the price came down, I was buying in. But it is, at the end of the day, if we're a shareholder, we're still the owners of those businesses. And I treat my portfolio as such. So if I owned a business, I'd want to know what my team is doing, what the management is doing, what is their future outlook, and how they're operating to things. If the response I'm getting back is something I don't feel comfortable with or I can't understand, then that's good enough reason for me to cut it out. At the moment, I actually feel strong about CSL. I do like it. And I feel like management are on the right track to doing what I would like to see coming out of CSL going forward.
So just for Meg, and I don't know if Meg already owns it, but say she does, and like you, pays attention to the information coming from the company, keeping in mind that it's backward looking, paying attention to what's coming in terms of strategy and the outlook. Still, if the market whiffs any sense of disappointment, the share price could fall exponentially on the day. Would you be a buyer?
Oh, I'd buy some more. Yeah. I mean, I've gone quite deep into CSL. As it came down, I kept buying in. Now, I won't lie, I was buying in all the way down from, around $200 mark all the way down. So I have been a buyer. I'm still marginally underwater on it, but that's okay for me. I'm okay with that because it's a long term. And do I see this company being materially larger in 5, 10, 15 years? Yes, I do.
All right, Meg, hope that answers your question. So put that, I think it was August 18th date on your calendar if you're interested in CSL, as the good people at Teaminvest are. Sanjee Narendran, thank you so much for joining us today. Really great to have you. And that is Wealthy and Wise for this week. Look forward to having another chat next week.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.